Question 1. Which of the following principles of insurance ensures that the insured does not profit from a loss, but is merely restored to the financial position they were in prior to the event? A. Principle of subrogation. B. Principle of insurable interest. C. Principle of indemnity. D. Principle of contribution. Answer: C. Principle of indemnity. Explanation: the principle of indemnity states that an insurance policy is designed to compensate the insured for their actual loss without allowing them to make a profit from the insurance claim. It ensures that the insured is restored to the same financial position they were in prior to the loss, neither better nor worse off. For example, if a car is damaged in an accident, the payout would be sufficient to repair or replace the vehicle, but not provide additional funds beyond the actual loss. While the other options are incorrect, A. Principle of subrogation refers to the insurer's right to recover the amount of the claim paid to the insured from third party who is responsible for the loss. B. Principle of insurable interest requires that the insured have financial stake in the subject matter of the insurance policy. This ensures that the person purchasing the policy will suffer financial loss in the event of claim. D. Principle of contribution applies when multiple policies cover the same loss, and it ensures that each insurer pays its fair share of the loss based on the proportion of coverage provided. Question 2. Which of the following actions is most likely to be considered an ethical violation under Georgia insurance regulations? A. An agent recommends an insurance product to a client based on their specific financial needs, even though it offers a higher commission. B. An agent discloses all relevant fees and premiums involved in a policy to a client before they sign. C. An agent changes a policyholder's coverage without their explicit consent to reduce costs. D. An agent reports all claims accurately and in accordance with legal requirements. Answer: C. An agent changes a policyholder's coverage without their explicit consent to reduce costs. Explanation: changing policyholders' coverage without their explicit consent is clear violation of ethical standards. Insurance agents must obtain informed consent from the policyholder before making any changes to their coverage, as this action could lead to unintended consequences and financial losses for the client. Ethical obligations include transparency, trust, and ensuring that the client's interests are always prioritized. While the other options are correct, A. Recommending products based on clients' financial needs, even if it offers higher commissions, is not necessarily an ethical violation as long as the recommendation is genuinely in the best interest of the client and complies with applicable disclosure requirements. B. Disclosing all relevant fees and premiums is a crucial part of ethical sales practices. Transparency in costs is not only ethical but also legally required. D. Reporting all claims accurately is part of the ethical responsibility of an insurance agent, ensuring that both the client and insurer operate within the legal framework. Question 3 scenario: Mr. Taylor has recently obtained a life insurance policy that covers his home and auto insurance through the same agent. 1 year later, he is notified by the insurer that his home insurance policy has been cancelled due to non-payment of premiums. Mr. Taylor claims that he never received any notification regarding the premium due and insists that he has always paid his premiums on time. What should Mr. Taylor do next according to Georgia insurance regulations? A. File a complaint with the Georgia Department of Insurance to investigate the cancellation. B. Contact his agent to request a reinstatement of the policy and payment waiver due to a misunderstanding. C. Accept the cancellation and attempt to purchase a new home insurance policy. D. Seek legal action against the insurer for not notifying him properly. Answer: A. File a complaint with the Georgia Department of Insurance to investigate the cancellation. Explanation: under Georgia insurance regulations, the insured has the right to file a complaint with the Georgia Department of Insurance if they believe an insurer has improperly cancelled a policy. The department can investigate the issue, verify whether proper notification was given, and ensure that the cancellation complies with applicable laws, including the policyholder's right to notice before cancellation. While the other options are incorrect, B. Contacting the agent for reinstatement and waiver of premiums is an option but does not address the regulatory side of the issue. Reinstatement can be negotiated with the insurer directly, but it's essential for Mr. Taylor to also seek regulatory assistance. C. Accepting the cancellation and purchasing new policy might be necessary if the cancellation is confirmed, but filing complaint should still be Mr. Taylor's first step to resolve any misunderstandings or regulatory breaches. D. Seeking legal action might be premature before exhausting the available regulatory channels. Legal action can be taken after exploring the complaint process through the Department of Insurance. Question 4. Which of the following best describes the principle of utmost good faith in insurance contracts? A. both parties to the contract must disclose all material facts that could affect the terms of the insurance. B. The insured must be truthful in reporting losses to the insurer, while the insurer is not required to provide full disclosure. C. The principle ensures that the insurer must act in good faith by paying all claims regardless of the policyholder's actions. D. Both the insurer and the insured must act in good faith when negotiating the policy terms, but no disclosure of facts is required. Answer A. Both parties to the contract must disclose all material facts that could affect the terms of the insurance. Explanation. The principle of utmost good faith, also known as Eurimi Fide, requires both the insurer and the insured to disclose all material facts that could affect the terms of the insurance contract. Failure to disclose such facts could lead to the contract being voided. This principle emphasizes trust and honesty in the relationship between the two parties and ensures that neither party withholds critical information that might impact the policy's performance or claims process, where the other options are incorrect. B. While the insured must report losses truthfully, this option inaccurately states that the insurer is not required to disclose information which is not true under the principle of utmost good faith. C. The insurer is not required to pay all claims regardless of the actions of the insured. Claims must be paid according to the terms of the policy, and good faith involves following those terms. D. While good faith is expected in negotiations, material facts must still be disclosed by both parties, which is not stated in option D. Question 5. Which of the following actions is required to maintain a valid insurance producer license in Georgia? A. The producer must complete at least 10 hours of continuing education every 2 years. B. The producer must submit a report to the Georgia Department of Insurance every year detailing all insurance transactions. C. The producer must attend a quarterly meeting with the insurance commissioner to discuss industry changes. D. The producer must maintain a minimum balance in a trust account designated for insurance transactions. Answer A. The producer must complete at least 10 hours of continuing education every 2 years. Explanation. In Georgia, licensed insurance producers must complete at least 10 hours of continuing education every 2 years to maintain their license. This ensures that agents stay up to date with industry changes, regulations, and best practices. Failure to complete this requirement can lead to the suspension or revocation of the license. Why the other options are incorrect. B. While insurance producers may need to report certain activities, they are not required to submit a full report to the Department of Insurance every year about all transactions. C. There is no requirement for producers to attend quarterly meetings with the insurance commissioner. Continuing education is the primary way to ensure compliance with evolving regulations. D. Maintaining a trust account is not a general requirement for insurance producers in Georgia. However, trust accounts may be necessary in some specific circumstances, such as for managing premium payments or handling client funds. Question 6. Which of the following is a key requirement for an insurer to operate as an admitted insurer in Georgia? A. The insurer must provide proof of financial solvency and meet specific capital requirements set by the state. B. The insurer must exclusively offer life insurance products within Georgia. C. The insurer must have at least 5 years of operational history in Georgia. D. The insurer must offer policies only to Georgia residents. Answer A. The insurer must provide proof of financial solvency and meet specific capital requirements set by the state. Explanation. An admitted insurer in Georgia is one that has been authorized to operate in the state by the Georgia Department of Insurance. To gain admitted status, insurers must prove their financial solvency and meet capital and reserve requirements as set forth by the state. This ensures that the insurer can fulfill its obligations to policyholders in the event of a claim. Why the other options are incorrect. B. A requirement to be an admitted insurer does not specify a limitation on the types of insurance products offered. An insurer can offer life, health, property, or casualty products as long as they meet financial solvency and regulatory requirements. C. The length of operational history is not a specific requirement for admission, though insurers must demonstrate financial capability and meet ongoing regulatory standards. D. While insurers may offer policies to Georgia residents, they are not limited to serving only Georgia residents to be considered admitted. Question 7. Which of the following is true regarding the process of rate filing for property and casualty insurance in Georgia? A. Insurance companies must submit rate filings to the Georgia Department of Insurance for approval before implementing new rates. B. Rate filings can be implemented immediately after being submitted to the Department of Insurance without approval. C. Insurance companies are required to submit rate filings only when rates increase by more than 10%. D. The Georgia Department of Insurance must approve all rates within 30 days of submission. Answer A. Insurance companies must submit rate filings to the Georgia Department of Insurance for approval before implementing new rates. Explanation. In Georgia, property and casualty insurers are required to submit rate filings to the Georgia Department of Insurance for approval before implementing any new rates. This ensures that rates are not unfairly discriminatory and are based on sound actuarial principles. Insurance companies must provide sufficient justification for any changes in rates, and these changes cannot be implemented until they are reviewed and approved. While the other options are incorrect. B. Insurers cannot implement new rates immediately after submitting filings. They must wait for approval from the Department of Insurance before applying new rates. C. Insurance companies are required to submit rate filings for any rate changes, not just when increases exceed a certain threshold. D. The Department of Insurance does not have a strict 30-day approval window, and in some cases, the approval process may take longer depending on the complexity of the filing. Question 8. Which of the following actions is prohibited under Georgia insurance regulations concerning fraudulent misrepresentation? A. An insurance producer exaggerates the benefits of a policy to a prospective client, leading them to believe they will receive a larger payout than the policy provides. B. An insurance producer discusses the details of a policy with a client to help them better understand coverage. C. An insurance producer discloses the commission rate they will earn from selling a policy to a client. D. An insurance producer offers a discount on premiums for new customers as an incentive. Answer A. An insurance producer exaggerates the benefits of a policy to a prospective client, leading them to believe they will receive a larger payout than the policy provides. Explanation. Fraudulent misrepresentation occurs when an insurance producer intentionally distorts the terms of an insurance policy to induce a client to purchase it, exaggerating the benefits of a policy to mislead the client into believing they will receive more than the policy offers is a clear violation of Georgia insurance regulations and constitutes fraud. Producers must provide accurate and truthful information to clients at all times, while the other options are correct. B. Discussing policy details in order to help a client understand their coverage is an essential part of the producer's duties and is not prohibited. C. Disclosing the commission rate is not prohibited and is necessary practice for transparency. D. Offering discounts for new customers as an incentive is common and legitimate marketing practice, provided that the terms and conditions are clearly disclosed. Question 9. Which of the following best describes the requirement for insurance companies in Georgia to handle claims in a fair and timely manner? A. Insurers must pay claims within 60 days of receiving a completed claim form unless additional investigation is required. B. Insurers must inform claimants of the status of their claims only when requested. C. Insurers must deny claims immediately if they believe they are not valid, regardless of any pending investigation. D. Insurers must inform the claimant about the claims process and provide an explanation of the reasons for claim denial within 30 days. Answer A. Insurers must pay claims within 60 days of receiving a completed claim form unless additional investigation is required. Explanation. Under Georgia insurance regulations, insurers are required to pay claims within 60 days of receiving all necessary documentation and a completed claim form unless additional investigation is needed. This ensures that policyholders are treated fairly and receive timely compensation for valid claims. If further investigation is required, the insurer must notify the claimant of the reason for the delay, while the other options are incorrect. B. Insurers are required to actively inform claimants of the status of their claims, not just when requested. C. Claims should not be denied immediately without proper investigation. The insurer must thoroughly assess the claim and provide a clear explanation if it is denied. D. While insurers must inform claimants about the claims process, the denial of a claim must be followed by a clear explanation, which typically occurs within 60 days, not just within 30 days. Question 10. Which of the following is true regarding the coinsurance clause in a property insurance policy? A. Coinsurance requires the policyholder to pay a portion of the claim amount, but only if the total claim exceeds the deductible. B. Coinsurance is a provision that requires the policyholder to insure the property for a specific percentage of its value, typically 80%, to avoid penalty in case of a partial loss. C. Coinsurance only applies to health insurance policies. D. Coinsurance allows the insurer to reduce the premium based on the deductible amount chosen by the insured. Answer B. Coinsurance is a provision that requires the policyholder to insure the property for a specific percentage of its value, typically 80%, to avoid penalty in case of a partial loss. Explanation: the coinsurance clause in property insurance policies generally requires the policyholder to insure the property for a minimum percentage of its value, often 80%, to avoid a penalty in the event of a claim. If the property is underinsured, the insured will receive a reduced payout in proportion to the underinsurance. While the other options are incorrect, A. Coinsurance doesn't apply only when the claim exceeds the deductible. It's based on the insured amount relative to the property's actual value. C. Coinsurance is used in property insurance, not limited to health insurance. D. Coinsurance does not allow insurers to reduce premiums based on the deductible. Question 11. Which of the following types of insurance policies typically covers a loss due to theft, vandalism, or fire? A. Homeowners insurance. B. Life insurance. C. Health insurance. D. Workers' compensation insurance. Answer A. Homeowners insurance. Explanation: homeowners insurance typically covers losses from theft, vandalism, fire, and other damages to the property. This insurance helps policyholders recover from events that damage their dwelling or personal property, while the other options are incorrect. B. Life insurance covers death and related benefits, not property damage. C. Health insurance covers medical expenses, not property losses. D. Workers' compensation insurance covers work-related injuries or illnesses, not property damage. Question 12. Under the elimination period in a disability insurance policy, which of the following is true? A. It is the period before benefits begin, during which the policyholder is not eligible to receive benefits. B. It is the maximum period during which a claimant can receive benefits. C. It refers to the total waiting period before an insurer pays the first claim. D. It is the period after which the policyholder no longer receives disability benefits. Answer A is the period before benefits begin, during which the policyholder is not eligible to receive benefits. Explanation: the elimination period in a disability insurance policy is the waiting period before the policyholder is eligible to receive benefits. During this period, the policyholder must be disabled, but no benefits are paid until the elimination period is over. Why the other options are incorrect. B. The elimination period is not the maximum duration of benefits, but the waiting time before they begin. C. The elimination period is not the same as the waiting time for the first claim to be paid. It applies to the duration before benefits start. D. Disability benefits typically end after the maximum benefit period, not after the elimination period. Question 13. Which of the following describes a peril under an insurance policy? A. A risk that may cause a loss. B. The deductible that the insured must pay before the insurer covers the claim. C. A specific event or cause of loss covered under an insurance policy. D. The amount of coverage provided by the insurance policy. Answer C. A specific event or cause of loss covered under an insurance policy. Explanation: a peril refers to a specific event or cause of loss that is covered by an insurance policy. Common perils in property insurance include fire, theft, and vandalism. Insurance policies usually specify which perils are covered, while the other options are incorrect. A risk is not the same as a peril, though risks can lead to perils. B. The deductible is the amount the insured pays out of pocket before the insurer covers the claim, not a peril. D. The amount of coverage is the limit of liability, not a peril. Question 14. Which of the following is a primary benefit of an umbrella insurance policy? A. It provides coverage for an insured's primary residence. B. It covers additional risks not covered by other policies, such as liability and personal injury. C. It is specifically designed to cover life insurance needs. D. It provides primary medical coverage for injuries incurred outside of the home. Answer B. It covers additional risks not covered by other policies, such as liability and personal injury. Explanation: an umbrella insurance policy provides additional coverage above and beyond what is offered by other insurance policies, such as auto, homeowners, or renters insurance. It often covers personal liability, including lawsuits, personal injury, and other risks not covered by primary insurance policies. Why the other options are incorrect. A. Umbrella insurance does not specifically cover a primary residence. C. Umbrella insurance is not intended to cover life insurance needs. D. Umbrella insurance doesn't cover medical expenses. It's focused on liability and personal injury. Question 15. Which of the following is true about the flood exclusion in a standard homeowners insurance policy? A. Flood damage is always covered under homeowners policies, regardless of location. B. Flood damage is excluded and must be covered by a separate flood insurance policy. C. Flood damage is covered if the damage is caused by a burst pipe. D. Flood insurance is optional and insurers are required to provide it to policyholders. Answer: B. Flood damage is excluded and must be covered by a separate flood insurance policy. Explanation: most standard homeowners insurance policies exclude flood damage. To protect against flood-related risks, homeowners typically need to purchase a separate flood insurance policy, often through the National Flood Insurance Program (NFIP). Why the other options are incorrect: A. Flood damage is typically excluded from standard homeowners policies. C. Flood damage caused by a burst pipe is not typically considered flood damage but may be covered under water damage provisions depending on the policy. D. Flood insurance is not automatically provided by homeowners policies and is usually purchased separately. Question 16. Which of the following best describes the purpose of the insuring agreement in an insurance contract? A. It specifies the duties of the policyholder in the event of a loss. B. It outlines the insurer's obligations to pay claims and provides a summary of coverage. C. It defines the exclusions of coverage under the policy. D. It lists the circumstances under which the insurer may cancel the policy. Answer: B. It outlines the insurer's obligations to pay claims and provides a summary of coverage. Explanation: the insuring agreement is the section of an insurance policy that outlines the insurer's promises to provide coverage and pay claims in the event of a covered loss. It essentially describes what the policy covers. Why the other options are incorrect: A. The duties of the policyholder are typically described in the duty of the insured section. C. Exclusions are generally listed separately from the insuring agreement. D. The circumstances for cancellation are usually outlined in a separate cancellation clause. Question 17. What is the primary function of a deductible in an insurance policy? A. It represents the insurer's maximum payout for a claim. B. It is the amount the policyholder must pay out of pocket before the insurer covers the claim. C. It is the portion of the premium that is refunded to the policyholder if no claims are made. D. It is the amount the insurer adds to the policyholder's premium to cover potential future claims. Answer: B. It is the amount the policyholder must pay out of pocket before the insurer covers the claim. Explanation: the deductible is the amount that the insured must pay out of pocket before the insurance company begins to pay for a covered claim. Deductibles are designed to reduce the insurer's administrative costs and discourage small, frequent claims. Why the other options are incorrect: A. The deductible is not the insurer's maximum payout. It is the insured's responsibility before the insurer starts covering claims. C. Refunds for no claims are not typically based on the deductible but rather on policy terms like no claims bonuses. D. The deductible does not relate to the premium payment but to the out-of-pocket costs before coverage applies. Question 18. What is a rider in an insurance policy? A. A rider is an additional fee added to the policy premium. B. A rider is an amendment that modifies or adds to the coverage of a policy. C. A rider is a legal document that terminates the policy. D. A rider is the policyholder's written consent for the insurer to begin coverage. Answer: B. A rider is an amendment that modifies or adds to the coverage of a policy. Explanation: a rider is an addendum or amendment to an insurance policy that modifies the original terms, providing additional coverage or exclusions. Riders are typically used to tailor the policy to the specific needs of the policyholder. Why the other options are incorrect here: a rider is not simply an additional fee, it alters or adds to the coverage. C. A rider does not terminate the policy, it changes or supplements it. D. A rider is not the policyholder's consent to coverage, it modifies the terms of the coverage. Question 19. Which of the following is an example of negligence in the context of insurance liability? A. A driver causes an accident after failing to stop at a red light. B. A homeowner experiences a fire in their home caused by an electrical fault. C. An insured's property is stolen while on vacation. D. An insured's car is damaged during hailstorm. Answer: A. A driver causes an accident after failing to stop at a red light. Explanation: negligence occurs when a person fails to take reasonable care to avoid causing harm to others. In this case, the driver's failure to stop at red light is considered negligent behavior, leading to an accident and potential liability for damages. Why the other options are incorrect: B. Fire caused by an electrical fault may be covered under homeowners policy but is not an example of negligence unless there was failure to properly maintain electrical systems. C. Theft during vacation is typically not considered negligence but could be covered event under an insurance policy. D. Damage from hailstorm is an act of nature, force majeure, not negligence. Question 20. What is the primary difference between an occurrence policy and a claims-made policy in liability insurance? A. An occurrence policy provides coverage for claims that arise during the policy period regardless of when the claim is filed. B. A claims-made policy provides coverage for claims that arise during the policy period regardless of when the event occurred. C. An occurrence policy only covers claims made during the policy period, not claims arising from events that occurred during the period. D. A claims-made policy provides broader coverage than an occurrence policy regardless of when the claim is made. Answer A. An occurrence policy provides coverage for claims that arise during the policy period regardless of when the claim is filed. Explanation. An occurrence policy provides coverage for claims arising from events that happen during the policy period even if the claim is filed after the policy period ends. A claims-made policy only covers claims made during the policy period regardless of when the event occurred, while the other options are incorrect. B. A claims-made policy covers only claims made during the policy period, not events that occurred during the period. C. This is the opposite of an occurrence policy, which covers claims made after the policy period as long as the event occurred during the period. D. A claims-made policy does not inherently provide broader coverage than an occurrence policy. Question 21. What is the primary purpose of liability insurance? A. To provide coverage for damages to an insured's property. B. To protect against legal costs and damages resulting from accidents or injuries caused to others. C. To cover an insured's medical expenses. D. To provide life insurance benefits to beneficiaries after the insured's death. Answer B. To protect against legal costs and damages resulting from accidents or injuries caused to others. Explanation. Liability insurance is designed to protect the insured from legal claims and financial loss due to injuries or damages they cause to others. This includes medical expenses, legal defense costs, and damages awarded in a lawsuit. While the other options are incorrect, liability insurance is not focused on covering the insured's own property, but rather protects against the damage caused to others. C. Medical expenses are typically covered by health insurance or accident insurance. D. Life insurance provides death benefits, not liability protection. Question 22. Which of the following best describes actual cash value received in property insurance? A. The original cost of the property minus depreciation. B. The replacement cost of the property without depreciation. C. The value of the property is determined by the insurance company's estimate. D. The amount the policyholder paid for the property without any deductions. Answer A. The original cost of the property minus depreciation. Explanation. Actual cash value (SCV) is the method used by insurance companies to determine the payout for a claim. It accounts for depreciation, meaning the insurer will pay the value of the property at the time of the loss, less any depreciation based on its age and condition, while the other options are incorrect. B. This describes replacement cost insurance, not actual cash value. C. The value is not determined solely by the insurer's estimate but includes depreciation. D. The policyholder's original purchase price is not the value used in SCV, as it is adjusted for depreciation. Question 23. Which of the following would typically not be covered under a standard homeowner's insurance policy? A. Damage caused by a hurricane. B. Damage from a fire. C. Damage caused by an earthquake. D. Damage from vandalism. Answer C. Damage caused by an earthquake. Explanation. Earthquake damage is typically not covered under standard homeowners insurance policies. Homeowners may need to purchase a separate earthquake insurance policy to cover such damage, while the other options are incorrect. A damage caused by a hurricane is generally covered under homeowners policies, though it may be subject to a separate deductible. B. Fire damage is typically covered by a homeowner's insurance. D. Vandalism is generally covered under homeowners policies. Question 24. Which of the following is a characteristic of a term life insurance policy? A. It provides coverage for the insured's lifetime. B. It accumulates cash value over time. C. It covers the insured for a specified period, such as 10, 20, or 30 years. D. It only covers death resulting from accidents. Answer C. It covers the insured for a specified period, such as 10, 20, or 30 years. Explanation. Term life insurance provides coverage for a specific period, such as 10, 20, or 30 years. If the insured dies within the term, the beneficiaries receive the death benefit. The policy does not accumulate cash value, while the other options are incorrect. A term life insurance only covers a specific period, not the insured's lifetime. B. Term life insurance does not accumulate cash value. This is feature of whole life insurance. D. Term life insurance covers death from any cause, not just accidents. Question 25. Which of the following is true about underwriting in the context of insurance? A. Underwriting determines the cost of the insurance premium based on risk assessment. B. Underwriting is the process of investigating and filing insurance claims. C. Underwriting refers to the process of selling insurance policies. D. Underwriting sets the amount of coverage provided by the insurance policy. Answer A. Underwriting determines the cost of the insurance premium based on risk assessment. Explanation. Underwriting is the process by which an insurer evaluates the risks associated with insuring a person or property. Based on this evaluation, the insurer determines the cost of premiums, the terms of the policy, and the amount of coverage, while the other options are incorrect. B. Claim investigation is handled by claims adjusters, not underwriters. C. Selling policies is the role of agents or brokers, not underwriters. D. While underwriting can influence coverage limits, it primarily affects premium pricing and risk evaluation. Question 26. Which of the following types of insurance would typically cover a business in the event of a fire, theft, or natural disaster? A. General liability insurance. B. Property insurance. C. Workers' compensation insurance. D. Health insurance. Answer B. Property insurance. Explanation. Property insurance covers damages to a business's property caused by various perils such as fire, theft, or natural disasters. It helps businesses recover from losses that affect their physical assets, while the other options are incorrect. A. General liability insurance covers legal claims for bodily injury or property damage to others, not the business's own property. C. Workers' compensation insurance covers injuries to employees but does not cover property damage. D. Health insurance covers medical expenses for employees, not property damage. Question 27. Which of the following would most likely be covered under an auto insurance liability policy? A. Damage to your own car after an accident. B. Medical expenses for injuries to passengers in your vehicle. C. Damages to another driver's vehicle when you are at fault. D. Theft of your vehicle. Answer C. Damages to another driver's vehicle when you are at fault. Explanation. Auto insurance liability policies cover damages to other vehicles or property if the policyholder is at fault in an accident. It also covers bodily injury to others, but does not cover damage to the insured's own vehicle, while the other options are incorrect. A. Damage to your own car is typically covered under collision insurance, not liability insurance. B. Medical expenses for passengers are usually covered under personal injury protection or medical payments coverage, not liability insurance. D. Theft of your vehicle is covered under comprehensive insurance, not liability insurance. Question 28. What is the primary difference between replacement cost and actual cash value received in property insurance? A. Replacement cost covers the full cost to replace property, while SEV accounts for depreciation. B. SEV covers the full cost to replace property, while replacement cost accounts for depreciation. C. Replacement cost only applies to cars and SEV only applies to homes. D. There is no difference. They are used interchangeably. Answer A. Replacement cost covers the full cost to replace property, while SEV accounts for depreciation. Explanation. Replacement cost is the amount needed to replace property with new items of similar kind and quality without factoring in depreciation. Actual cash value SEV includes depreciation, meaning the insurer will pay the value of the property at the time of the loss less depreciation, while the other options are incorrect. B. The correct distinction is that replacement cost does not consider depreciation, while SEV does. C. Replacement cost and SEV apply to various types of property, not just cars or homes. D. There is a clear distinction between the two terms. Question 29. What does comprehensive coverage in an auto insurance policy typically cover? A. Only damages caused by a collision. B. Only medical expenses resulting from an accident. C. Non-collision related damages such as theft, vandalism, and natural disasters. D. Only damages to third parties. Answer C. Non-collision related damages such as theft, vandalism, and natural disasters. Explanation. Comprehensive coverage in an auto insurance policy covers damages to your vehicle that are not caused by a collision. This includes damage from theft, vandalism, natural disasters, and other non-collision events, while the other options are incorrect. A. Collision coverage, not comprehensive, covers damages caused by a collision, B. Medical expenses are covered by medical payments or personal injury protection, not comprehensive coverage. D. Damages to third parties are covered by liability insurance, not comprehensive coverage. Question 30. In the context of health insurance, what is coinsurance? A. The amount you pay before your health insurance begins to pay for covered services. B. The percentage of the cost of a covered service that you pay after meeting your deductible. C. The amount your insurance company pays after you reach your deductible. D. The fixed amount you pay for a medical visit or prescription. Answer. B. The percentage of the cost of a covered service that you pay after meeting your deductible. Explanation. Coinsurance is the percentage of the total cost of a covered service that the policyholder is required to pay after meeting their deductible. For example, if a health insurance policy has a 20% coinsurance, the insured pays 20% of the cost of the service and the insurer pays the remaining 80%. Why the other options are incorrect? A. This describes the deductible, not coinsurance. C. Coinsurance applies after the deductible, not after it is fully met. D. The fixed amount paid for a visit is typically called a copayment, not coinsurance.